focusing on what it will take to build sustainable businesses, foster innovation, and stay ahead of the curve. From changing consumer preferences to scaling in a competitive market, there is a lot to unpack as we look ahead. To help us decode these trends, we brought together some of the brightest minds in the ecosystem. This panel isn't just about what's happening today, but about charting the path for the future. And we're lucky to have leaders who've been at the forefront of India's startup story. To lead this conversation, I'd like to welcome Nandan Nilekani, Chairman of Infosys and the Chair of our jury this year. Welcome, Nandan. I'd also like to invite three industry leaders who have not only set benchmarks in their fields, but have also redefined what success looks like for startups. Peyush Bansal, co-founder and CEO of Lenskart, who's transformed eyewear retail in India and beyond. Aadit Palicha, co-founder and CEO of Zepto, who's disrupted the quick commerce space at just the age of 21. And Subrata Mitra, partner at Accel, one of the most prominent venture capitalists backing some of India's biggest startup success stories. Do tag your takeaways with hashtag ET Startup Awards. Over to you, Nandan.
Thank you, and it's a very exciting group, and we have an exciting panel. At least he's wearing the Stanford T-shirt, I mean. And so what we'll do is we'll do a quick summary of what happened the last 10 years and then move into the future. And I sort of broke this up into multiple segments. The first segment, of course, is the growth of startups. And I was looking at the data, and there has been a dramatic increase in the growth of startups in India. And today, this year alone, 2023 was about 35,000 startups. So as Satyan was mentioning, when the ET Awards began, we had less than 1,000 startups. So the Startup Awards are also a startup. And today we have more than 100,000 startups. And this has really dramatically changed everything. And where did these startups come from? Startups begetted more startups. So we did an analysis and saw that out of Flipkart, we had so many, and then Flipkart had PhonePe, and then PhonePe had one card. So it's like grandfathering of startups is going on and on. And you see the ones from Zomato, Swiggy, Zoho, Paytm. So there's a dramatic growth in startups from startups. In other words, people who got their skills, maybe some of those guys that Dipinder left did more startups. So I think so we see a huge growth of that. And it's not just that startups beget startups, but startups also came from large companies, from Infosys, from ITC, from GCCs. And then, of course, the ultimate archetypal startup is two college dropouts, which is our friends here at Zepto. And in the style of Bill Gates and Steve Jobs and now Aadit and so on. So I think we are seeing startups from everywhere, and that's the growth we are seeing. So I just want to talk, what have you seen? I mean, the founder density has just gone through the roof. What's happening here?
Clearly, I mean, I probably don't keep track of the numbers like Satyan does, but the number of people walking through the door at Accel has actually skyrocketed. So we probably now, in 2015-16, we were probably 3,000-4,000 startups in a year total that would come to us. That number must be 13, 14, 15,000 now. So 5x growth in that period of time.
And the quality of the entrepreneurs?
Oh, absolutely amazingly changed. I think, the ability to deliver scale, that actually creates so much of, mental bandwidth that people are now not even scared about things that, we used to think, like in the early days of Flipkart, we were like 50 orders when I came in. How do we get to 500 would be something that we would worry about. Today, that is like negative infinity. If you do 500 orders, you're not even on the board. You have to do 50,000 orders to get started, right? So I think we, as an ecosystem, we have seen so much scale around us, and some of it, all the public infra that you have helped build. Transactions are becoming like that, right? So people are now able to visualize things at like 100x the scale that we were seeing 10 years ago.
Piyush, what's your feeling? I mean, the whole talent thing is a big thing, and how do you keep guys when everybody wants to go and start another startup?
I mean, that's the main thing, to be honest. I think if I look at 10 years back and now, the only thing that has changed is to keep talent density very high has become harder and harder, because there is only that much high quality talent, and to keep them, to hire them, to retain them, it's not easy, which means you have to up your game all the time. And I think that is the game. If you can build the right culture, and everybody has their own culture which works for them, and you can figure out a way to attract the best talent and retain them, rest everything can happen. Unfortunately, I think, or fortunately, I think in the past 10 years, we have been focused on tangibles. The intangibles are only getting the focus now and I think it is now that people are beginning to realize that human resource is not human resource, it's human capital, that we will get to the journey of globalization. Because I think to build a company outside India and to build a global company, that is what is the milestone we need to cross as a country, as a lot of companies. If we can focus on that, I think we can go global.
Great. Aadit, what gave you guys the courage at 19, first year college, Stanford, dump all that and start a company?
Yeah, no, I want to start by saying I think I've made the mistake of taking the Silicon Valley dress code too seriously. I think I'm probably the only one that's done that. But no, I think we never really started the company with the objective of starting a company. KV and I came to Bombay during the pandemic. We loved coding and building as kids, and we had nothing really to do. So we said, might as well, build something fun and solve a problem around us. And that was a hobby growing up. And we did that for a couple of months. I think the most pronounced problem at the time was grocery delivery. First wave of the pandemic, chaos, getting grocery. Online would take 5, 6, 7 days in those times. And even offline, getting grocery was a nightmare. And so we said, might as well just help some of the neighbors around us. Most of them were elderly. And we said, okay, let's just get on a bicycle, deliver groceries on a WhatsApp group. And then it slowly iterated into an app. And then that slowly iterated into a model where we build warehousing and logistics over the course of about a year. And I think what gave us conviction to actually take the call to drop out was not some big ticket, let's go for it, but it was real sort of input customer product market fit. I mean, we were seeing customer love very early on in the journey. And after we saw people using the app and using it multiple times, us growing organically and scaling, that's when we knew we were really onto something. So it took us a year to get there, but then when we had really solid foundations, do we say, hey, we can take a risk and go for it.
So did you take a deferment or you just quit college?
No, so we took a year off first, and then by the end of that year, we had product market fit, and then we went for it. And Y Combinator was probably the biggest biggest accelerant into us feeling confident in doing that, because they actually gave us the framework to say, do you have something real, or do you not have something real? And the ultimate input metric for a consumer company at the time, at least for us, was retention. And so we could see retention, and we said, Y Combinator says we've got something, hopefully we've got something. So yeah.
Great. So the next thing is, what happened to the money? Now, the VC funding grew dramatically, and we had that bubble year of 2021. It's come down, but still there is a lot of funding that is going on. But what's interesting is the number of unicorns being created. Even in these dull years, there have been unicorns created. And every year there have been more and more unicorns created. This year itself, we have Rapido, Aether, and Perfios. And what's important, and Deepika mentioned it, I think the growth in IPOs. And in this period, you're seeing a steady growth in the number of IPOs. So clearly, the whole capital game has changed from just little VC money to money from different rounds, from public markets and so on. And so what's changed in the last 10 years on money?
So I guess, investing is about these two cycles, right? So greed and, being greedy and being scared. So I think we keep sort of oscillating between those two. And it'll be hard to say that it is all behind us, because I'm sure, all the people who DP has made into multimillionaires, they are starting to invest into other startups, which will now go and start looking for money elsewhere. So this is a cycle, but like you said, there is a new pool of capital that has got opened up now, and we should all seriously start looking at what does it mean for our startups and for all our companies. How do we build in a sort of a sensitive way so that we keep public market investors in sight when companies start to grow.
So you look at that right now, right in the beginning, when you think of companies, you think of when will they go IPO?
Maybe not immediately, but we are starting to see profitable companies, even with 10 or 20 million of their own revenues, are now thinking about it because they now see that in the next 10 years, this 10 million revenue can become 100 million, right? So you grow at 20-25% year on year, and you have some overall efficiency so that your bottom line grows faster than the top line. That's actually a valuable property in the Indian public market scene. So it is being taken very seriously by many of our companies across the board.
Sure. Adit, your last valuation was at what value?
It was 4.9 billion post.
And you publicly said it will go up to 50 billion in market cap.
Hopefully in the next decade or so. That's the ambition.
That's too long.
That's the ambition.
Decade. Why decade?
I agree with you. We're trying to do it sooner.
All right.
Aim high and do it faster.
All right. So what is your experience of capital raising and the changes that you're seeing?
Yeah, no, I think for us, we, pretty early on in the company's life cycle, we started in 2021 effectively is when we got product market fit and started raising capital. First 7-8 months was euphoric. 2021 we raised 4 institutional rounds back to back in the span of 9 months, right? Then as a 9-month-old company went through the worst capital markets situation since 2008. As a very early young company in a highly capital intensive space. And, pretty quickly, I think that, at the time was very difficult and devastating because we had scaled very rapidly and we said, okay, we have to build a lot of operating leverage very fast. But looking back at it, I think going through the 2022-2023 period has given us DNA of fiscal discipline and operating rigor, which today is paying dividends, right? And so I think going through that early in the company's life cycle, seeing near-death experiences, almost running out of capital twice, having to raise a round in 2023, which was back-breaking, and I'm sure the founders that have tried to raise capital 2022, 2023, there'll be lots of horror stories, but going through all of that, having that embedded into the DNA, not just for me, but for the leadership team that's stuck with us since day one, has been very helpful. And now obviously we've raised 2 large rounds this year, and we think it's on the back of us being able to prove execution for those 2 years, solving for most of the downside risk very early in the company's life cycle, and then talking about the greed factor, saying that, hey, we've solved the downside risk, now let's go for the big leagues. And that's been what it is. But I think one thing that I'll mention is, or maybe the 2 quick things that I'll mention is, one, I think raising capital has become a lot more detail oriented. It's been a lot more. It's a lot less about the high level. What's the India story? What's the potential for the company? It's a lot more about, let's get into the operating mechanics. What's the leverage that you're building? What's the return on equity on every dollar that you're investing if you're investing capital? In our case, what are the payback periods for the store? What's the payback period for every customer that you're acquiring? What are the initiatives that you're building to keep improving those payback periods? That level of depth, candidly speaking, most of the very aggressive investors, when we were raising capital in 2023, they were no longer investing. So we had to only go to much more traditional, much tighter pools of capital that pushed us along those lines. And I think now, when I speak to more traditional VC or like more, conventional VCs, they're also going in that direction of going into details and operating mechanics. And the last piece that I'll mention, I think you spoke about public markets and raising from capital from public markets, right? I think for us, what's starting to become evident and what happens with most mature ecosystems in internet, if you look at the US and China, is that an IPO stops becoming a climactic event. It simply becomes a capital market strategy,
sure,
right? And I think that's starting to happen, where there won't be much of a difference if you're a public company or a private company. And you can, if you go public because you see real value in that as a capital market strategy for the long term. I think one of the best companies that have done that is, for example, Airtel, right, 2 decades ago. So hopefully that happens this time around in startups.
Great. Piyush, what's been your capital journey, and you're also looking at public markets?
See, for us, I think, to be honest, we didn't need as much capital. We didn't have as much competition as some of the other categories, and we had some early mentors in the business who told us what are the things that would matter. So I think from a unit economics perspective, we were quite okay. From a capital raising journey, I think we raised almost $500 million of capital. 350 million went into an acquisition. 200 million is in the bank, right? So we haven't, and we have done over $1.2 billion of secondaries.
You've been making money from day one or what?
No, it's just that the unit, I think in India we understood very early. We had this early on, we got Manish Chokani as one of our advisors. And Manish told me, Piyush, in India, if you want to succeed, keep your margin at 70%. Right? If you're not at 70%, it'll always be a tough life. I think that kind of hit me hard enough. And then when I met, once I got an opportunity at a Sequoia event, I met Tony, Zepto's founder, and he told me that, I don't believe in this LTV CAC, just remember this. If you can recover your money in the first transaction, that's all that is important. Rest, everything is a story, which, in a cyclical turn, you'll be in, there'll be a bull's market and then things will come down. I think we held on to those principles. I've always found that more than capital, the quality of capital is very important. Right? There have been instances, and sometimes I think we as founders also get carried away into raising valuations too much. It's not sometimes the best thing for the company. Getting right quality partners, if one wants to go really long term, I've often found getting obsessed over valuation is the wrong thing for the company. Because, see, India market is trading at multiples which many international markets are not today. And those macro factors could change in times to come. But that shouldn't take away, okay, now what we want to do. So I always say valuation, etc., should not be founder's job. Our job should be to have our vision clearly on the impact that we want to create. Then valuations will keep changing. That said, I think money is becoming smarter over the last 10 years, right? We have seen the journey of the Tiger Global journey. We have seen the SoftBank big ticket size journeys. We have seen, investors becoming more cautious about things. So it's evolving. It's evolving. But I do really think one should use capital very cautiously. It is one of those things which makes you not deliver your A game every now and then. So if the company starts if the company starts treating, if a rupee to a company starts looking like a lakh rupees starts looking like a rupee, which often happens, and I've seen in that journey, in my own journey, something is going to be wrong in the future, right? So
yeah, thanks. So I think I'll quickly go. Of course, we also have built all this digital infrastructure. I won't harp on this, UPI, Aadhaar, and you can see the change in pace of all these things. And this has made a big difference, but we won't spend time on this. But I will come to corporate governance. Now, these are just headlines I picked from the Economic Times. And you can see how many different cases are there of all kinds of accounting, disasters, fraud, and so on. So, Subrata, are the VCs to blame for this?
I mean, I don't know if I want to take the entirety of the blame, but let's just say that everybody probably has a part to play in it. I mean, if you are pushing the founders beyond reasonable limits, what is that human being going to do? They're probably going to find some shortcuts at some point of time, and that's human nature, right? So are we trying to push that boundary too much? But at the same time, I think there are situations where investors don't know about it, and then there are situations where investors can guess that something is going on. So I would say if we have a situation where we can guess something is going on, we need to act very, very rapidly. And as long as all investors are doing that in earnest, I think we'll have a much better ecosystem. But there are clearly situations where, because we are, at board meetings maybe once a quarter, and we are not doing, forensic audits of companies for several quarters at a stretch, it is sometimes very hard to know if there is something really wrong until it's like really too late. So I would categorize it in those two categories. If you get a sense, and sometimes markets actually tell you. You may not know as the guy on the board, but other people might start to know that something is wrong with your company. And you have to take those signals very seriously. So to that extent, we are doing it. I would say, we are probably moving in the right direction. And again, I think everybody has to share the blame a little bit.
I'll just move quickly. The other thing which is, I think, what I call as bridging the Mumbai-Bangalore divide, which is that earlier, 10 years back, all this digital tech was only Bangalore and Gurgaon. I'm sorry, Deepinder. 10 years back, it was mainly in Bangalore and Gurgaon, and now the large companies of Mumbai are doing tech, and IDFC First has a great tech story. Kotak Bank has, State Bank has YOLO. So I think we are seeing a lot more of digital transformation being done by large companies. Tata is doing new. So I think we are seeing that trend where the startup world has excited the incumbents also to do something. And one other trend is the disruptors getting disrupted. In other words, e-commerce came, and then quick commerce came and disrupted e-commerce. The cab hiring came, and now you have Rapido and Namayatri disrupting cabs. You have, earlier in education, you had Byju's and Unacademy. Now you have Physicswala. So in every sector, you're seeing new players coming, which are making a difference. So I thought we'll just focus on the rise of instant gratification and the future. So Adit, you personify this, right? I mean, isn't this all about instant gratification?
I think there's definitely some truth to it. There is, some magic in getting atoms delivered to you in a few minutes, clicking on an item and seeing it in front of you instantly. There is definitely a delight factor. I think but it does go deeper than that. I think when we talk about convenience, and this is, what I've heard a lot of, investors and operators in consumer internet say, they trivialize the word convenience. Say convenience as if who cares really that much about convenience? It's a very thin value proposition. It's all about price. It's all about maybe selection, et cetera, right? But, when you look at, a play like us, or even if you look at globally what's worked in consumer internet, there's often something much deeper than just the instant gratification that's driving product market fit. I mean, if you look at, let's say, the user stickiness and the retention of a platform like quick commerce, it's, multiple times better than even the best consumer internet formats that have come prior to us, which should tell you something. And, if you look at, the first 2 to 3 years of quick commerce, again, people trivialize it saying 10 minutes, who the hell needs anything in 10 minutes, right? What people didn't pay attention to is, hey, customers love the product. Why do they love it? Is it frivolous, or is there something real behind it? And we spoke about it briefly before this conversation, is that when you actually go deeper and you speak to customers, they tell you that, hey, we like buying products in small tickets multiple times a week. And it's not just because it's convenient, but it's also because, a large portion of our basket is perishables. We have to buy that fresh multiple times a week. Or for example, I don't have a four-wheeler. I can't really do a bulk stock up use case. Or I can't, for example, I don't have a large amount of storage space at home. Or, in many cases, I've got low amounts of disposable cash flow. I'm an MBA student. I don't want to put, 60 to 70% of my disposable cash goes into grocery and household essentials. I don't want to put all of that up front at the beginning of the month. I'd much rather do that in small tickets multiple times a week. And so, when you double click on it, it goes beyond convenience and gratification, and it goes into consumer patterns that I think are fundamental. And, when you look at why quick commerce is working in India, it's, I think, largely because we've been able to cater to that small ticket multiple times a week use case that is unique to Indian commerce, which if you go to the West, for example, it's precisely the opposite, right? It's large baskets 1 or 2 times a month. And the data point here is the average frequency of transactions in India on grocery and household essentials is 2.2 times a week. In the US, it's 2.4 times a month, right? And so,
what's the average ticket size of a purchase on Zepto?
Yeah, I mean, it varies, you can say around 500 rupees-ish, which if you look at even if you look at the decade prior, you look at grocery even in the offline world, it's been around 480 rupees. So, yeah.
Piyush, I mean, you've built amazing multi-channel immersive experience. Why has that been so critical for your success?
See, firstly, I would say there's no rise of instant gratification. It's the only truth that has remained permanent, right? Rest, everything has changed because, you know,
So it was
it's
always
only
instant gratification.
people always want it, right? I mean, nobody wants SEO. People want SEM. That's why Google makes so much money because people want to get the click and get the money now. That is instant gratification. It's just that people are now beginning to provide that more and more. So it's going to remain forever. I want faster, cheaper, better all the time, right? And so coming to your question on omnichannel, see, overall, fundamentally, consumers want everything, right? They want to have their journey of enjoying themselves in a mall, and they want to enjoy their online journey. They want all of it. And economically also, if you look at India, 1.2 billion, you look at any developed market, what percentage of people are shopping online? 10, 20, 30% people are shopping online. But what we often forget is there are 70% people who are maybe not shopping online, but they're definitely browsing online. And which I call it as and all the marketing, advertising money, all the product innovation money that we are spending is going to that 70% also because they are coming and engaging on your platform. Now, everybody's trying to maximize if 100 people are coming on your website, assuming your conversion is 4%. Let's say you'll do good UI, UX, you'll spend millions of dollars. 4 will become what? 6, 7, 8, right? But technically you are playing within the 30%. 70% of everything else you are doing is going waste. So omnichannel is nothing, right? Omnichannel is saying, okay, can I add a little bit of assistance to get that person who's influenced online to convert in some other form. So that 7-8% conversion can actually go to 30-40% conversion, and then you can have your first time LTV to CAC. There's no need of LTV to CAC. You can actually make money on the first transaction. And from a consumer experience perspective, you know, I'm having a higher quality of life in all spheres. I want an iPhone. I don't care whether I'm buying it online or I'm buying it offline. And it also depends on what the company wants to do. In our case, people come, we are not mistaken with people come to Lenskart to buy a higher quality of specs at lower price with a better design and faster every day. And there is no end to it on how much better it can get. Now we have to just keep delivering that in all spheres. We are not a medium company. So.
Okay.
And how early did you realize this? The fact that omnichannel will be super important for you?
Actually, omnichannel is a buzzword, if you ask me, right? It's a word where, you know, investors like to tag, you know, models of what works, what doesn't work, and
sure. But investors get the blunt of everything. But please explain.
Yeah. See, when we started as a pure online company, there's a tool called Calleroo where you go and ask customers surveys of people on your website. So we often used to ask why people who are not buying. And one of the things that 70% people, maybe 80% used to say that I like to touch and feel and try. It's not rocket science. Now, if we were chasing valuation, if we wanted to make our investors happy, I would not even look at that input. I would just say this will lower my valuation. I'll not be an online company. I'll not be a tech company. But my customers wanted to touch and feel. So I just planted a store between my office and my home, you know, and I saw that for first month, I was doing better than every optician because these people were already online influenced. We were delivering higher quality at lower price with better content. So that's what, and now after a few years when people saw this is making money, people call it omnichannel. So we just realized very early on that if you can ask every day for the next 100 years why people who are buying, why people who are not buying, and you're clear about what is the purpose of your company, and you're not building for public market or private market or A investor or B investor, you can keep going. And then market will find new ways to term it. Omnichannel is one of them.
Good point. Yeah, thank you.
Great. So I think let's move on. Next 10 years, Adit, you're the youngest here. You're about 1/3 my age. He is. So what are you seeing? I mean, what's the journey you're seeing? What's the vision you have?
You know, for Zepto, just generally, internet.
Generally, both you and the market. What do you think?
No, I think you know, Piyush mentioned something important that, you know, we have to build global companies in India. I think somewhat similar, we have to build truly exceptional internet companies in India that can be benchmarked to the Meituans, the Pinduoduos, the Coupangs, the you know, the Airbnbs or the Ubers or the Mercado Libres of the world. You know, companies that are generating billions of dollars of free cash flow or close to that, hundreds of millions of dollars of free cash flow, and doing it at significant scale. And, you know, we are still early as an ecosystem. We've not, with few exceptions, and, you know, few companies that are very close to getting there, we've not really gone the full distance yet. And I think over the next decade, that's pretty much what happens, right? If you look at, let's say, the US in the 1990s, it was you know, first time internet companies were getting created, huge bubble, you know, nobody knew what they were doing, a lot of investing was happening in the wrong companies, lots of, you know, poor execution was happening. 2001, there was a reality check, most companies died. The next decade, the same founders, the same investors, the same operators learned from the mistakes, built much higher quality companies. Same thing happened in China, 2002, 2008, right? A lot of garbage in that period. 2008, there was a reality check. Next decade, there was a much higher quality crop of companies. If you look at India, candidly, I think, you know, we haven't done a phenomenal job, I don't think so, over the past 10 years as an ecosystem. I don't think so, right? If you compare it to the US or China or any, even Latin America or you know, parts of Asia, I think we could build much higher quality companies. It's a function of the same cycle, 2012 to 2021, first cycle of internet. Interest rates were 0%, capital was free. Nobody had seen companies create so much value before in India. Lots of, you know, mistaken investing happened. You pointed out to some of the accounting errors. That was just one of the many mistakes that we made as an ecosystem. But then 2022, 2023, we've had a pretty rough reality check that I think, you know, as someone that raised capital in those markets, and I'm sure Piyush has seen this as well, is probably much more of a bloodbath than is even visible outside in. Sure. Unlike in 2001 where it was public. And I think the next decade we build much higher quality companies.
So you think that the next decade we're going to see companies of the size and scale of the American and Chinese internet companies?
Hopefully. I think we've got a shot at doing that. I think you know, companies like Zomato, the companies like Grow, that really have a shot at very large scale outcomes. And now we started also unlocking TAMs of that size. Like if you look at, for example, quick commerce, right? The TAM that we have is comparable to, let's say, the TAM that DoorDash has in the US.
Oh, I see.
If you compare it, even if you cut, let's say, you know, certain set of cities, certain income demographic, it's actually comparable to food delivery US TAM. And, you know, DoorDash does, I believe, if I'm not mistaken, 77 billion of GMV, you know, a few $1 billion of free cash flow, right? And so now there's no market size excuse. There's no capital excuse. There's no talent excuse. It's just execution. Sure. And I think it happens in the next 10 years.
But one of the things is global, right? I mean, for example, you have gone global. So is going global part of it? I mean, you're taking your model to how many countries now?
I mean, we are mostly in Asia, Middle East, and, you know, Asia is quite fragmented. So number of countries can be large. So we are there in 15 countries, but yeah, we are largely in this part of the world.
What percentage of your sales is outside India?
About 40.
Wow. So you see that as a growth path for all the, like you may go to, no, you don't see yourself
it's
going.
not about the growth path, Nandan. I think there is so much to do in India, right? The market size is not a problem, but I think people in India, particularly investors, get very worried when companies are going outside India because there have been more failures than successes, to be honest. And that brings to our earlier point about talent. I think we need to, I think in the next 10 years, we will end up, and we do need to change the orbit we are operating in. Because I think from trying to create, you know, we have to create impactful companies, because companies without which the world would not be the same in that sense. I mean, what would the world be without a Microsoft Office? What would the world be without a Google search? And I think today, our view is that, okay, this founder got a $1 billion exit, and that's the biggest moment for us. But I think we have to change our equation in terms of, are we creating that kind of impact globally? Second, I think we need to create organizations that can grow and run sustainably for decades to come. You know, I mean, today we have we have an Amazon, which has been there for so long, executing in India in a very, very competitive, solid way, which one would only expect of a founder-run company in India, right? And I think we need to build organizations that can do that and replicate that. And that's not easy because that requires talent, culture, a machinery that is self-propelling. That is when we'll create organizations of large scale. And third, I think we need to create consumer brands. I still feel that we are so awed by global brands. I think the same needs to happen for Indian brands going globally. We can't be in the same light as people think about, oh, this is an ex-country brand, this is the why. People need to respect. So I think we need to change that journey, and that would happen. That would happen.
Sure. Subrata, what do you see? I mean, you're seeing the
Yeah,
last...
actually, you know, whatever these guys are doing is absolutely phenomenal. And they are obviously going global in a sort of a limited way. But if you look back, you know, for us to win globally, we should probably already know what those sectors are. And in my opinion, these are things like space tech. These are things like services. So all of these are now going through a new evolution. You know, obviously Elon Musk has done a bunch of things on space tech, and Indian companies actually now know how to compete in that arena. Hopefully some of them become truly global. You know, services is getting into this head-on collision with AI. A lot of innovation is going to happen. And it is fair to say that people in the West don't understand services. So it's probably fair to say that we will be some of the best companies, you know, marrying AI and services together. So at least these two areas I see will be large winners from India, and these could be massive, you know, because services TAM is already 300-400 billion, and if you can, just in India. So I see some massive companies coming in these two sectors. And then, you know, just talking about this whole India ecosystem, you know, our public market, for good or bad, is already 5 trillion. The way it has gone from 3 to 5, it will probably go from 5 to 10 in maybe less than 5 years. And some of these companies which are in the room are today probably 150 billion, you know, market cap, all put together. Even if that grows to, let's say, 4x, 400-500 billion, there is still room for another 400-500 billion worth of, you know, tech startups to participate in that, you know, 2x growth of the capital markets. And I'm hoping, you know, there'll be a lot more 5 and 10 billion companies that will come out of India. And it could be, you know, I think one of the things I liked about both of these guys is, you know, focus on your customer. So that I find in a lot of pitches that I see that it's sort of nebulous. You know, I'm building something and maybe somebody will buy it. As opposed to going outside in, you know, who's my customer? Why should they buy from me? What is their alternative today? And why should I be better at putting that product or service? I heard it clearly from these two guys. So clearly, you know, that's some of the reason that they're successful. But if we continue to be that way analytical about who the customer is and try to get their value proposition out there, in every sphere we'll do well, but I think these two specific ones are going to be really good.
So would it be fair to say that the last 10 years were just a warm-up act and the real action is the next 10 years?
Oh, absolutely. Maybe even the 10 after.
Okay.
I think we will still warm up in the next.
20th year function. But next 10 years, let's talk. So you think that there'll be a scale change in the next 10 years?
Yes, 100%. I think it'll be faster. Because we are just beginning to learn how to run a company right now. We haven't really done innovation and R&D. We are just trying to figure out. For us, the game is right now is, and I keep reading LinkedIn, are we red or green? I think we have to get out of that game, are we red or green? That can't be the game, are we profitable, not profitable. The
like
game
how many spectacles do you make in a year?
I mean, right now, 50 million.
Wow. And what will you be doing now? Your next factory?
Yeah, the next factory would be doing about 250 million.
Jeez.
I mean, we have to serve 1 billion people. I mean, that's the goal. The sooner we get to, we can think of the next dream.
So you can service the whole world, no?
We should. The way I look at it, if we didn't exist, the world would not be the same.
Okay.
So we have to do something about it. I mean, there are globally 5 billion people who need glasses. Half of them are without it.
You can service all of them.
Yeah, so that's 2.5 billion people and population is growing. So if we serve 1 billion people, we would have made some impact.
Okay. So you also feel this is just a warm-up last 10 years? Or in fact, you sort of implied that we didn't do a great job in the last 10 years, so now we'll do a great job. So,
yeah, I mean, like, I think, you know, we have to be intellectually honest with ourselves, right? Like, have we built a Uber or an Airbnb out of India of that scale, billions of dollars of free cash flow, or even like close to $1 billion of free cash flow? Not yet. I think we'll get there. And so I absolutely agree. I think this is warm-up act. You know, we've learned hard-fought lessons. You showed a brilliant chart of, you know, entrepreneurs coming out of companies, learning what went right, what went wrong. In some cases, there are some companies that are now worth more than the parent, right? Which is interesting. So I think it's just day one. Like, we're getting started. But we really, you know, if I were to benchmark the internet ecosystem, it would be like how many $50 billion plus companies are created over the next 10 years. I think we desperately need that. I mean, you know, I've had the unfortunate privilege of having to spend too much time with investors in the past 6 months, right? And when you speak to the really serious capital allocators, right? CIO Fidelity, APAC, for example, or you speak to T. Rowe Price, they're not all in on India. They have some questions because they're saying, you know what, I put 100 million into Nubank, it became a $70 billion company that's doing $2 billion of free cash flow. I've seen that in Latin America. Where is that in India? Right? So we still have to prove ourselves. We're still very much the young, hungry kids on the block that have not yet made it. So
great. Well, we need many more people like you.
I just want to add to that.
Yeah,
you know, I
sure.
think the last 10 years, we were trying to see, can we become profitable? I think the next 10 years will be, how are we allocating our profits? You know, allocating that money will become the biggest question mark for companies, because everybody is beginning to make profits now. Everybody, where there was a question mark, can companies make profits? All those question marks are getting answered, and everybody is making profits, and huge amounts of profits are going to flow in. But how do we use that money will be very crucial, I
Great.
feel.
Thank you. And I think the message is the last 10 years was just a warm-up. The real action starts now. And thank you to Subrata, Peyush, and Aadit. And I hope you had a good time. Thank you.